Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Rick Miller, who's the founder of Miller Wealth Planning, and we'll be talking about what Americans need to understand about IRMAA. Rick, welcome to the program.
Hey, Mike. Thank you.
Hey, I want to understand all things about this person, this lady named IRMAA. Haha, I know that's a joke, but before we dive into that, give us a little bit of your story and background, and how did you get into the industry?
Well, that's a great question. I've got a long story. I have originally I started out as a college English and communications teacher. Did that for a number of years. Got a couple of master's degrees. Ended up, however, in the financial arena. I owned a mortgage company in Virginia for about 17 years, grew that from an operation out of my den to 4 locations and 55 employees. When I sold that business, I had already planned my next step, and that was to become a financial advisor. And I'm a few months away from my 27th anniversary in that business.
Wow. You've been in the business a minute or two and probably seen all kinds of topsy-turvy times and can tell stories all about it. So I know that ties into how you serve your clients. So for sure, we want to dive all into how you guide your clients to plan for retirement. Well, first of all, like I jokingly described this person named IRMAA, let's clarify what IRMAA is. It is the acronym IRMAA. What is IRMAA?
Well, that stands for Income-Related Monthly Adjustment Amount, which, of course, doesn't tell you squat, does it? It's a government deal, and let me to fully frame this out for you and your listeners. Let me go back in time a little bit. In 1935. FDR signed the Social Security law. And of course, at that time, and he actually is recorded as saying that Social Security is not designed to ever be a tax resource. Well, of course, Congress had other ideas, and President Roosevelt is long gone. And the first couple of things that they did was set it up so that depending upon certain income levels, 50% of your Social Security benefit could be taxed. And then they raised that to as much as 85% of your Social Security being taxed. Now, the next step in our little IRMAA story here began in 2003 when the Medicare Modernization Act, it put in place the earliest framework for means testing Medicare and Social Security. And when you hear that term means test, what that means is that, in essence, if you have the means, you're going to pay. In other words, the more assets you have, the more income you have, the more means that you have, the higher your tax burden is going to be when it comes to IRMAA. So the next and most significant piece is that the Affordable Care Act accelerated what I would term as the penetration of IRMAA into the financial lives of Americans. And basically, Mike, this is a stealth tax on your Social Security where a portion or potentially even all of your Social Security benefit is taken from you to pay your Medicare costs. So this is where that concept of means testing kind of returns with a vengeance. And again, there are very little ways to avoid the risk most of the income that people make, salaries, bonuses, investment income, even income from tax-free bonds is all considered as the government figures out what your particular IRMAA subsidies might be. So this is something that also, in addition to being relatively new and pretty much all encompassing, there's very, very, very little recognition out there in the public yet about how this works and the impact it can have on your finances, particularly in retirement.
And similar to, as you were explaining that, it made me think of driving down the highway in a state you're not familiar with, and you're speeding and you get pulled over and you're like, yeah, but I didn't know. Well, the officer doesn't care you didn't know. It's the law. It's posted. You sped. You get the ticket. Same with this. It's like, I don't even know how to pronounce IRMAA, spell IRMAA. I don't know what it does, but if it triggers, there are things you need to be aware of. And the best time to be aware is not to react, but to be prepared. So let's talk a little bit more about who is most at risk, in the sense that, what if it's someone like, oh, well, I only earned this and I'm certain that I wouldn't be at risk. But then you have some other people that are high affluent earners with large portfolios. Which is the end of the spectrum that is most at risk?
Well, without question, the people that have higher incomes, larger assets, greater cash flows throughout their lives, those are the ones that are going to be hit the most by IRMAA. One of the things that is most annoying about this, or difficult, is that this has just kind of been plopped onto the tax code over, the last number of years, and people are seeing they're getting bills. Let me give you an example.
Okay.
The more income and assets that you have, the greater your IRMAA obligation could be, to the point where your entire Social Security benefit, average Social Security benefits probably say $3,000 a month, $2,800, something like that. If you earn too much, and again, everything in terms of your earnings, your required minimum distributions, all of that factors into the IRMAA taxation. It can get to a point where your entire Social Security benefit can be consumed by IRMAA tax. Now, that seems incredible. I mean, there's actually a law that was passed that Social Security is not supposed to be accessible beyond the 85%, assuming what your income is. But the IRMAA legislation completely set that aside. And so what people have seen is that not only, and again, people of means, people of wealth, assets, and income, they can get a bill from the government, from the Treasury Department, Social Security Department, saying that even though you paid 85% income tax on your Social Security, and the rest of it was consumed by IRMAA, you still you're still going to be taxed on what you didn't receive, if you're following me.
Wow.
Yeah, it's staggering. It's really staggering that this could essentially be dropped on the American public without any knowledge or warning. Now,
Yeah.
why is this happening? Well, it's pretty clear that, and I think most Americans are aware, that Social Security's broke. Medicare costs as we have a rising population in terms of population numbers, people getting older, the baby boomers, and so on. The stresses on the Medicare system are also enormous. And so this was an under the radar vehicle for the Congress to address that reality, that there's not enough people working to continue to be paying into Social Security to make it solvent. And when you add this additional IRMAA burden, it just has created an extremely difficult situation for, in my view, people who have done everything right. You've worked hard, you've saved, you've invested. You're at a point in your life, when you're starting to take Social Security, and of course you have to. You can't have Medicare unless you elect Social Security, and vice versa. There's no opting out of that relationship. So it's not something you can say, well, I just won't participate. That's not an option. And so people who have done everything right are finding that, particularly the last 25 years of their lives, 65 up, there's this huge financial obligation that nobody was prepared for.
Yeah. And you don't know until you know. And it's very similar to like the RMD rules. Like you have to take out X% out of these accounts at this age at a certain time. But if someone goes, oh, I sold my RV, I don't need cash this year, I'm good to go. The government doesn't matter. If you needed to take it out, you needed to have done it and you'll face a penalty. So let's think about this, Rick, through all of the points you've brought up here. What can be done to mitigate some of these costs?
Well, that's the great question. And I'm glad to say, after relating all this uncomfortable and annoying and angering information, that there are ways to mitigate IRMAA. And like so many things in life, the sooner you recognize this, the sooner and more effective your mitigation efforts will be. Mm-hmm. And I can point to a couple of things. In the list of income or assets that are not not usable by IRMAA, we have Roth IRAs. Now, the Roth IRA is distinct from a traditional IRA in that a Roth IRA has no tax implication in the future whatsoever. In other words, it gives you the opportunity to grow your money in a tax-free envelope. And you also have the ability to move traditional IRAs, 401ks, thrift service plans, 403bs, other qualified employer plan kinds of financial instruments into a Roth IRA. Now, you must recognize that that creates a taxable event in the year that you would do such a conversion. But here's the thing that you have to consider. Is it better to take the hit now, pay a tax now, and have then 15, 20, 30 years of tax-free compounding and tax-free use of that money? Plus, if there's money left over in a Roth IRA that you never used during your life, your children or grandchildren will inherit that tax-free money as well. So, by comparison, if you just have traditional IRAs, when you pass, your spouse will inherit it exactly in the form that it is. She can move it, she can change it around, but there's no tax to her. However, if a non-spouse beneficiary inherits a traditional IRA, now they are forced to take that money out over a 10-year period and be taxed on it. So what I'm leading up to, Mike, is that as a part of an overall financial strategy and financial plan, there's a way that you can begin to mitigate, and in many ways, very significantly mitigate. And I've even seen IRMAA almost eliminated by using this Roth conversion technique that also has the long-term benefit, Mike, of passing assets onto your children in a much more favorable tax position, if you get what I'm saying.
Yeah, and I want to clarify two things because I'm tracking right there with you. And I think that the word mitigate does not mean eliminate, as we know.
Right.
But there's no way to eliminate all taxes. Yay. You see that on social media and you run from those posts, But mitigate means to lower as much as humanly possible based on your circumstances. And that's my definition. I'm sure that it's pretty close, but I think that's a big thing to think about. And secondly, I want you to comment on that plus this, the point that you made about the Roth conversion and triggering taxes in whatever tax year. You certainly, again, I know we've mentioned this before. Don't go out and Google and I'm going to go convert and I'm going to transfer. You're going to run yourself into a potential big problem because if depending on the size of your 401k or IRA, you might need to do a multi-year conversion process because you want to get right up to the limit that's best for you, but not past that. And you've got to work with a financial professional for that.
Well, yes, that's absolutely correct. I mean, in my 27 years, one of the things I learned very early is you got to understand what's in the fine print. You have to understand what the rules, what the implications are, what the penalties are. And, Americans you gotta love us. We are do-it-yourselfers. We love to be self-reliant. But honestly, Mike, when it comes to things like this and so many other investing and retirement kinds of questions, you really don't want to do it yourself. You need sound, experienced fiduciary advice to make sure that you don't make mistakes. Because I'll tell you this, the IRS does not have a sense of humor. If you and believe me, in my 27 years, I've seen some terrible examples where people thought they knew what they could do and ended up having, turning a $250,000 employer plan. In this case, it happened to be a TSP, thrift savings plan, into a $250,000 tax event in 1 year by making a simple error that was not reversible. IRS said, tough. TSP said, tough. It's always what you don't know that hurts you. And these are areas where you've got to be certain you're on the right track.
Yeah. Well, I'll tell you, let's kind of wrap this up with, if someone is thinking, I recognize that this could be something to think about. I have no clue where to start. What is the first thing that you would say to someone to check out to see if that would warrant a further discussion in their specific situation before reaching out and connecting with someone like yourself? Where do they begin thinking?
Probably the first question would be to their tax preparer.
Okay.
Because he or she is going to have the numbers. They're going to have their history. They'll know what the income is. And they are sufficiently aware of the rules that say, to put them in a position to say to a client, you might want to consider Roth conversions. And Roth isn't the only tool in this endeavor to mitigate IRMAA. There are others as well. It's just there's a much higher level of recognition and understanding about Roths, and that's why I bring that up. But there are other ways to do it as well.
Yep. Well, I tell you, if that triggers something in someone's mind to go, you don't know what you don't know, and I'm ready to know it, what's the best way that they can reach out and connect with you to learn a little bit more, Rick?
Well, they can certainly go to my website, MillerWealthPlanning.com. They can shoot me an email, rickmilleradvisor@gmail.com, or they can simply call. My cell phone is 703-401-3672, and I'd be happy to listen to where they are and give them the best advice possible.
Perfect. Well, Rick, thank you so much for coming back on. It's been a real pleasure chatting with you.
Oh, same here, Mike. You take care.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.